All right, so welcome to another video. Today, what we're going to do is we're going to go ahead and take a look at why covered calls can be more profitable than simply just buying stocks. Okay, so if you just are into buying stock, that's okay, not a problem. But I'm going to show you why and how covered calls can be more profitable. Now, there is also a caveat here where if a stock explodes to the moon, then you're not as profitable. But I want to show you some insight here. So that way you can see how many of the times it can actually be much more profitable. All right, let's take a look at some of these things. I do want to remind you that we do have a website here. And if you want to take a look at it, there's a ton of great freebies. Just go to tradersfly.com and you can check it out. You can also download a ton of freebies in there. And then if you want to check out some of the courses, we also have something specific on covered calls. And also, if you want to do some coaching regarding covered calls, you can also do that and work with me directly. All right, so let's get started and take a look at kind of the profitability picture overall of covered calls. Okay, so the way that you make money from covered calls is that you buy a stock, just like you're buying a stock. So here, let's say I buy a certain stock here. So this is my stock position. I buy it here. So here's the price of the stock. Here's our profit. And as that stock goes up, I make money. But with a covered call, I'm looking to sell that stock at a higher level. So it might be up here. Now, by doing this, I'm selling ahead of time. I might receive, let's say, $150. Okay. Could be $50, could be $200, could be $800, depending on the stock, depending on the price, volatility, and many other factors. But let's say I'm getting $150 to wait. Now, if it doesn't get there, I still collect $150. Now, I still make my premium or profit here from the stock, but I also make my money from the call that I've sold. So here we sold one, and here we bought 100 shares of stock. Okay, so I make money. Where's the profit come from? Profit comes from the stock on its own, from what it goes up or down. So in this case, up, if it goes up. And then what happens is if it goes to this level, okay, let's say it gets to 180, you bought at 150. So if it gets to that level, then you also plus make money from the call that you sold. Now you still make money from the call even if it goes down, but in addition, you make money from that call that you sold. So this is where the advantage comes in, because many times a stock will just go, there's different levels of speed. It might go very quick. It might kind of go sideways, pull back a bit, and really tank. So many of these actually will be just fine. So if it goes sideways, okay, you make money from the call. If it goes up slowly, okay, you won't lose the stock. If it goes up a little bit quicker, you'll still at least make money from the call and the stock. Now, if it goes up too fast way over here, you don't get to make this premium because this is where you said you would sell the stock. That's kind of the disadvantage of it. So let's take a look here on the panel and platform. I just want to show you that. So let's say I am interested in, let's go in with Lowe's. And let's say I buy 100 shares of stock. Okay, show you. Okay, if I've got 500 shares of Lowe's right here, okay, and I'm buying it right now at 196 right there, and I say, hey, I'm willing to sell it at about 200 to get out of the stock. Well, I could make 1,700 from the stock itself, but you know, I could go 16 days out and say, okay, I'm willing to sell that stock at 200. Well, I've got 500 shares here, so I could sell 5 of these contracts. And now from that alone, okay, I make another 1,750. So in total, if that stock gets to 200, I make 1,700 here and I make another 1,700 there. So in total, when you really look at it, okay, let me just move this over. Okay, what you'll see here in this lower left corner, when we actually go up with the stock, you'll make 34, 35. Okay, now the great news is if the stock pulls back, okay, right here, let's say it goes down to 190. Okay, well, I'll only lose 1,548. Whereas without that call, I'd lose 3,000. So that helps cushion you this $350 for 5 contracts helps cushion you if the stock actually pulls back or goes against you. So this is a really powerful way of doing it. So most of the time the stock is not going to the moon. So if it goes up slowly, you get to make a little bit of extra money. The downside, if the stock just jumps to $220, you don't make the profit from 200 to 220 because you have to sell your stock early. So there's always a trade-off in trading. There's no gimmies. So you're trading one risk for another. But what happens is you're able to, at least if it goes up slowly, you make additional money. If it pulls back against you, you get to capitalize and not lose as much. If it goes up pretty quickly, you still get to make a little extra money, but as long as it's not exploding to the moon, you're not kind of missing out on gains. So the big issue is if it really explodes, you're going to miss out on some gains. So anyway, I hope that helps, gives you some insight on really why these can be much more profitable. Really, it's because you're getting money from the sell side already and getting paid to wait for that stock to come to that price. And if it doesn't, you get to still keep the premium. Now, if it goes beyond that strike price that you choose, then in that case, you lose the stock, but that's okay. You're selling it at a higher price than what you bought it at. So in either case, it's a pretty good situation in most cases. But if the stock keeps going down, you get to keep making some of that money or premium to protect some of that position. So anyway, I hope that helps. Truly appreciate you sticking with me. Check out the website. There's tradersfly.com, and you can check out some of the coaching one-on-one stuff that I do, courses, and many other freebies and so forth. So I'll see you next time.